So we're going to focus on fundraising because we don't want to fall in the trap of running being unprepared, having no process, and running this part-time. We're going to temporarily quit our startup to focus the CEO only on fundraising. So the CEO is going to run a company that, and this is just as an example, the customers are VCs, your product is going to be your data room and the process that we're going to see, and your go-to-market strategy is going to be getting warm introductions, how to do cold emails at work, and also running a tight process. Now, because you're only going to be focusing on the round, about 80% of the work happens before your first meeting. The work of fundraising doesn't start with your first meeting. And you just have to know that you're going to be knocking on 99 doors before getting your first yes. Typically, when I am helping founders raise money, it is around the 30th no that founders start getting demoralized. After the 50th no, they become really good at integrating perspective and feedback and moving forward in a way that is not demoralizing anymore. Now they're improving their pitch, improving their narrative, moving forward and doing the better segmentation. It is after the 99th no that you can expect to get the first yes. So do not expect that this is going to be very fast, or very easy, but we can optimize. And so the first goal that we have is to overkill in preparation. And what I mean by overkill in preparation is if you're doing a pre-seed round or you're doing a seed round and you don't have network and pedigree, even more important, if you don't have network and pedigree, you need to come up to the first meeting and everything that you produce and show and how you behave with investors as if you were doing an A round or a B round or a C round. Think that you need the materials as if you're doing 2 rounds ahead. There are some people that because of their background, their network, they're able to raise millions of dollars based on a PowerPoint and a vision. That is not most cases, and that is not the case of outsiders. So we want to over on preparation. And I will show you what that means. These are the basic things that you need to bring to the table to come prepared. You need to be prepared with a 15-second pitch, a 30-second pitch, and a 60-second pitch. You need to have a pipeline that starts around 200 possible investors. Now, most investors I've spoken to, or many of them, I'm not going to say most, many of them say like, why start with 200? Just research the right investors, and there's going to be a few number of investors that are right for you, and reach out to them. Well, what happens is you're decreasing your rate of success. If those 5 investors say no, you're out of luck. I'm going to drop in the chat so that you don't worry about taking notes. I'm going to drop the notes for this conversation, this workshop today. Plus, there's a bunch of links that have a list of VCs and a way to sort them. Jessica, I'm going to need your help putting that link because it is telling me that I already sent that message, and I did, but it was a test. So Jessica will send over that link on our notes and a list of hundreds and hundreds of VCs. The idea is that each VC that you research is not just the name and to invest in your vertical. You go to their website, you go to their bios, you go to their LinkedIn, you go to their Twitter, and you find things in common and you find things that are interesting to them to justify why they would be a good investor with you. Now, we're going to get to, all right, we have a pipeline of 200 VCs and how to get a warm intro to them. Many VCs don't like cold emails. I've heard from many VCs that say, if you're not good enough to get an introduction, then you're not good enough, or to find a way to get a warm intro, then you're not good enough to be CEO. I disagree with that. I think there is a way that you can build a network and get in or do cold email that doesn't necessarily correlate with you being a good CEO or a bad CEO. Just some people are born lucky, they win the lottery of birth, and they have the path where their network is already built in. If you don't, there's a way that you can work smarter to get there. And we're going to cover that. Now, we're not done with everything you need to prepare. Next, because you have to identify them, it's a prospect list. You're going to run this like a sales process. So if you've ever done political campaigning or fundraising for political campaigns, it's knocking on doors. The next thing you're going to prepare is a forwardable email and your copy or the text you're going to write for cold emails. The forwardable email is a key element that we use for getting introductions within the Techstars network. The essence of a forwardable email is that you have a common connection between the person you want to get to and the person that can introduce you. So let's say that you wanted to get to somebody that I know. I am going to be the introducer to that person. A forwardable email makes it so easy for me to forward your email to your target that I have to do zero work. We want to have a zero work forwardable email. And a great forwardable email is one that has a personalized reason of why that investor is a good match for you. And it needs to be something that goes beyond, oh, I saw that so-and-so invest in fintech and I am a fintech. Let's say that you know somebody in common and you want to get introduced to me. One, you don't need a warm intro. You can just email me. My email is really easy. It's just the letter a@techstars.com. But let's imagine that I was one of the VCs that says, I only take warm introductions, which there's plenty of. What you want to do, and let's say that I am the common connection that you have. And because you can cold email and you can apply to Techstars, you can get into the program. I'm connected to a lot of investors. This is what I do all day, every day. You will send me an email with the personalized message. I get it, and it has the 3 bullet points of what your company is doing and the progress that you have, plus a 1 or 2 lines that is super personalized on that target. I receive that email. All I'm going to do is click forward and then put in the email of the person that you want to reach and say, hey, Joe, so-and-so is a founder of my portfolio or whatever it is. They would be interested in meeting you. More information below. Or it might be even shorter for me because I'm going between an airplane to a cab to a meeting. And so it should be the forwardable email, the text, like my company does X, Y, and Z. This investor is relevant because ABC. These are 3 most important aspects of it, 1, 2, or 3, like it's our progress. I will click forward and I'll type in the word to Joe, the target, interested, and that's it. At that moment, Joe can say, yes, please introduce me. Or Joe can say, not relevant for what we're doing right now, or I invest in a competitor. I'm not going to waste the founder's time. That is a forwardable email. It still needs to be very well researched. Now, let's say that you wanted to write a cold email. I am very easy to reach, but imagine that I weren't. You can send me a cold email, and there's a cold email saying, hey, Andres, we're raising an A round, raising $10 million. Would you be interested in meeting the CEO? I get a bunch of those emails because I am in some database that everybody spams. I usually reply and I say, great, how do you see Techstars relevant for your A round? And then they're like, oh, sorry, I hadn't seen that Techstars invest in pre-seed. That's because they were just spamming. A better cold email would be, hey, Andres, I saw the stream that you did on the Techstars LinkedIn and on Crowdcast on hacking fundraising. I like the approach of being over-prepared with a data room and the 1-pager and the 15, 30-second, 60-second pitch. Here is my data room. Do you think I'm missing something? Do you think it's over-prepared? Is it good enough? That's one way because it shows that you did the homework. Now, the annoying thing is that you have to do this for 200 investors. You just have to do it. There is no shortcut around it. Or you could say, hey, Andres, I saw your blog post about how to get to product market fit and how to do customer discovery. I followed those questions. This is what I learned. I would love to show you what I'm doing and how I'm approaching getting to product market fit. Now, those 2 emails shows somebody that did their homework and it is catering to my ego. I am more likely to respond, yeah, I will. Yeah, sure. Let's do a 10-minute call because I know that in that 10-minute call, it's going to be an interesting conversation. It's not going to be the same thing of, oh, Andres, what do you typically invest in? All of that's on the website. So doing an extra personalized email helps with cold emails and also keeping it super, super short. All right, so now we have a pitch, 15-second pitch, 30-second pitch, 60-second pitch memorized. We have a pipeline of 200 VCs, which you can get from the notes that I shared with you. You now have a forwardable email, cold email. You have the base, but then you also have the personalized lines for each investor. You have a one-pager. And remember, the goal is overkill. I know this seems like a lot, but that's the point, is to be overkill. And I'll show you why a little bit. And we're going to prepare an emailable deck. When an investor says, hey, Andres, send me your deck, I'm going to have a version for email. Then I'm going to have a different version for the meeting. Typically, I love this, using this style. This is Prezi Video, where I don't have to share screen, because the moment I share screen, people check their WhatsApp, their Slacks, their email. So having here, this could be my meeting deck, where I only have graphs and a big number, maybe a big word, but I don't have paragraphs and paragraphs as text. And I have a leave behind deck, which is after you do the presentation deck, they're like, oh, could you email me the deck so I can share with the partners? Great, here's my leave behind deck. That is a deck that explains, or a slideshow presentation that explains itself without you having to be in the call to explain it. Then we get to the data room. The data room, if you're focused on fundraising, this is what takes about 2 weeks of work before your first meeting. Remember that I said that 80% of the work happens before your first meeting. This is what a great data room looks like. I know it's super small text, but this is a pre-commit data room for a pre-seed company. Let me see if I can make it a little bit bigger. So we have a bunch of documents. We have the financial model, we have the go-to-market document, we have testimonials, we have competitive analysis, we have roadmap, we might have cohort analysis. It will change from company to company because each company is different. But as a starting point, this is what it should have. It should have a financial model that are not financial projections. And you're probably thinking, wait, a financial model like this early? Like, who knows? What do you want me to say? What do you want the spreadsheet to say? I can make it say that. I am asking for a financial model, not financial projections. Another way to think about this, which is how one of our friendly VCs and former managing director says, is Trey Honeycoff. He says, imagine it is a business simulator. And the example he uses is before, for designers of cars, before they build the car and test it, they would use clay, and they would build a model of the car in clay and test the wind, the aerodynamics of it with clay. Then when we had computers, now they're using computer modeling to test the aerodynamics of a car with a computer model. Well, for your business, that computer model is a spreadsheet. Or you can use one of our other Techstars portfolio companies, Forecaster, that will help you with that. But the goal is that when there is a conversation with an investor and they say, well, why are you charging transaction instead of SaaS? Or are you taking a commission? Why is your take rate 15%, not 80%? How can you get your margins to go from 40% to 90%? If you don't do a model, the answer is like, I don't know. But when you do a model, you can actually model out, have a tab of the spreadsheet with all the variables of what happens if I give away the software as a service, I give it away for free, and I just charge a transaction fee. Or what happens if I have a 30% take rate versus a 15% take rate. All of that will model out the results of your business. And that will help you have a stronger answer when somebody pushes on why this and not that. It might be that they also send you a question of like, hey, we'd love to see your financial projections. You have a financial model ready, and you can use that to say, hey, here's the top line financial model. Let's get on a call so I can drive you through all of the model, and we can play with the levers that we can push that have an impact in the business. When they ask you, hey, what is your go-to-market? The answer, it could be, 10 seconds. We're doing partnerships with universities. Great. That's a 10-second answer. But because we want to be over-prepared, we'll do partnerships with universities and work with influencers and then be installed in phones automatically with a deal with Samsung. And by the way, here is a 6-page document that is our go-to-market strategy. Same thing for competitive analysis. When they go, well, haven't you heard of this competitor? Yeah, of course we've heard of that competitor. Well, what makes you different? XYZ makes us different. And here's our 6 pages of competitive analysis. Same thing for testimonials, same thing for roadmap, because the objective is to show up to the meeting over prepared. when you're talking to very early stage investors, when you're talking pre-seed, seed round, there are not enough data points in your financials to show that this company is going to be a success. There's not enough track record in your company because it's a new company. You might have the track record of being a serial founder, but you already have, if that's the case, you already have a network and pedigree. But what happens if you don't have that network and pedigree? You don't have a track record of having created multiple companies that have exited, generating millions or billions of dollars through VCs. The only thing you have left is coming better prepared than anybody that VC has met ever, or at least that year, or at least that month. Any of the TechSource founders that go through my program, usually when they go off fundraising, are so over-prepared that the VCs, whether they invest or not, mention, wow, Andres, I saw the data room of CredFeed. It was so complete. It was so well prepared. That is the only thing they have to judge you on because it's still very early days. And with that goal complete, now you can start having your first meetings. And here is where your goal is to create scarcity and momentum. Now, the following tips I will give you are very controversial. Most VCs or many VCs do not like this approach, but it works. It turns out that a VC, and I've been doing this for years, we know the game, and founders don't know the game. So the idea with the TechSource program is that we can teach you all the behind the scenes. And the idea with what I'm going to show you today is how I have seen that works the best to get the most money in the door as fast as possible by generating scarcity and momentum. There is no one way, but this is the way that I've seen it work best, especially for those founders that don't have network and pedigree in only the earliest of rounds. Because what works in pre-seed might not work in seed and might not work in the Series A, especially with what I'm going to show you. So the first two tools, and only two tools that we have in addition to being over-prepared, are increasing the cap and generating calendar density. What do I mean by increasing the cap? You're probably going to hear from investors, or you've seen Shark Tank. It's like, we'll give you $100,000 for 5% of the business. They're going to be asking you, well, what is the valuation or what are the terms? And one way of doing it is having, especially if it's later stage, like doing a price seed or a Series A, the best thing you can do is allow a lead investor to set the terms, but capture all the interest as a soft commit. But what happens before you get to that stage? What happens when you're pre-seed and you don't have network and pedigree? This is how I suggest founders do it. Now, these numbers are an example. For yourself, you need to do your own model and figure out what your numbers are going to be. These numbers are not for you to share with the VCs. This is what we're going to have internally. And I'm going to have them here, but it's just for you to look at. That is not what you're going to show investors. So I'm going to go with what the conversation with investors would look like. This would go away, and I would say, oh yes, I'm Andres. I'm helping founders raise money faster. That's my product. And when they ask me, well, Andres, what are the terms of the round? Like, what's the valuation? I'll say, well, it is a tough market. And of course, we want to go back to work as soon as possible. So we're raising $750K at an 8 million post-money cap safe. However, to reward the early investors that have the conviction to sign and wire the safe without there being a lead, without there being any more information than what I provided in a very deep, dense data room, we're going to be allowing the first $250,000 at a deep discount of a $5 million post-money cap. After the $250,000 allocation has been used up, the remaining allocation, we're going to leave it at an $8 million post. And so what happens there is now we have created scarcity, right? And again, these numbers are an example. And the reason why I use these numbers as an example is because I have memorized them. It doesn't mean that this is what you should use or what every startup should use. And in this case, we gave up or sold 5% of the company here at the top, 5% of the company with that 250K, right? And then the remaining 500K was for 6.25% of the company. That will fulfill the 750K. And because we have an increasing cap and the 250K was used up really fast, and then the 500K, now we have momentum, so then the 500K will commit, sign and wire really fast. That's when we can say, and you need to model out a scenario where the only money that you raise is the 750K, but you'll also model out a scenario where you raise an extra 1 million. And so what happens after you have the 750K is if typically there's more demand than what you can take at that valuation that you set of 8 million. Because if you give up too much more, then you're going to be getting a lot of money at a lower valuation and you're going to be very diluted for future rounds. So what at that point you can do is say, hey, our 750K allocation filled up and we have decided to extend another million. This will help us get XYZ. Before we could only get W, now we're getting XYZ in terms of progress and outcome. And for that reason, we're raising another million at a $12 million valuation. So what's happening there is your total raise was 1,750,000. And the total number of shares that you sold or the ownership that you sold is 19.58%. Good dilution is anywhere between 15 to 20%. 25% is okay. Above that, it starts becoming a little bit tricky because for next rounds of funding, you're going to get more diluted and it can be a problem for later investors. So this is the increasing cap approach or high resolution fundraising. Many VCs do not like this because their pushback is going to be, well, what's the difference between yesterday and today that your valuation went from 8 million to 12 million? Since there was no real change in the business. The real answer is, well, supply and demand. But the diplomatic answer is we were rewarding the investors that were high conviction, invested early, signed and wired the money early, without waiting for a lead, without waiting for more traction. And so they got the better prices. This is how we create scarcity. Now, there's this beautiful graph by Jason Ye. I suggest that you follow him on social media. He has great content that talks about calendar density. Here is what founders typically do. If you look at the one on the right, they have a loose process with zero pressure. This loose process with zero pressure happens when you get introduced to one investor and you talk to one investor. Let's say today, Tuesday, May 9th, they get introduced to one investor via email. And I'm super excited to meet that investor. I say, hey, investor, would be happy to meet you. When are you available? That investor says, sure, let's meet Friday. Great, see you Friday. Then on Thursday, I get introduced to another investor. And that investor says, yeah, would love to meet you next week, Wednesday. Great, let's meet next week, Wednesday. And then next week, Tuesday, I get introduced to another investor. And they say, great, let's talk in 2 weeks. Sure, we'll talk in 2 weeks. So that process generates zero pressure. What we want is the type process with calendar density, the one here on the left. In this process, we are having all of our meetings in the same time period. It means that you could have gotten all the introductions spread out throughout the weeks. One introduction this week, another introduction next week, another introduction the week following. But rather than agreeing to meet everybody as you get them, you pull them together. And when you pull them together, you have calendar density. So when they ask you, hey, Andres, your startup looks really cool. You help founders raise money faster. That's great. Many founders need that. How far along are you in the round? Do you have a lead? How much capital have you raised so far? It might be that this is my first meeting. I spent 2 weeks creating a data room and doing all this work to come over prepared. But if I have calendar density, I can say, well, today's first meeting, you're my first meeting, first day of fundraising. And of course, like any founder, we want to raise fast and get back to work. But just to give you an idea, we have 40 VC meetings this week. So now the investor knows that if there's no conviction or they're not really interested in you, they'll just tell you right away, rather than taking the free option. The free option is when they don't commit and they say, oh, sure thing, super interesting, I'm going to share with the partners, send me your pitch deck. Here's your pitch deck. It's already done. Here's my leave behind pitch deck. Okay, cool. And maybe if you have the financial, here's a financial model. And we had that question about go-to-market. Here's a 6-pager document on go-to-market. Everything's already ready. Plus, they know that you have 40 meetings with VCs this week. So they're going to prioritize you and no longer exercise their free option. Because they also know that if they're the first meeting and they write the small checks, $50,000 check, $100,000 check, $250,000 check, if they move quickly, they're going to get to the lowest valuation cap, the early allocation, the 250K at 5 million. In this example, you have to do your own numbers to figure out your valuation. And so by running a tight process, you have a higher chance and an easier time to raise money. And before I go and talk about what goes behind the scenes and the motivations of a fund, I want to make sure that there are no questions on anything that I've mentioned right now. So I will answer any questions you have. Are we recording this? Yes, we're recording this. And what if, yeah, go ahead.
Hey, Andres. So we have a few questions that came in through the Ask a Question button. So this might be from earlier in your presentation, if you're okay with covering some of those.
Oh, yes, the great questions. All right, do you recommend racing from multiple accelerator programs, or should we stick to only one and not over dilute us? Well, I will selfishly say that you should consider Techstars as your main one. However, it is normal, we have seen it before, that founders go from one accelerator prior to Techstars and then they apply to Techstars. We invest anyway. The cool thing about Techstars is that we take common stock, which is different than a safe or preferred stock, in the sense that typically common stock is priced at a fraction of a preferred share or an investor share. Our common stock purchase agreement doesn't trigger a pricing event. And because it is common stock, we get paid when founders and other common stockholders like employees get paid. So the Techstars deal is compatible with VC funds and doing safes and doing other types of financing. It can be detrimental if you go from accelerator program to accelerator program and each accelerator program is taking lots of equity with post-money saves. That can play against you. So ideally, you would do Techstars and that's it. But if you did another program before, you can still apply to Techstars. It won't hurt you and you can still get in. But after that, I wouldn't recommend doing more and more accelerator programs. And then we have another question from Chris. How can we have that many, 200 investors, if we don't even have the warm introductions? and they all refuse the cold emails. All right, so let's talk about that because I did promise we're going to talk about that. The best people to introduce you to an investor are founders that have received capital from those investors. Because as investors, we always ask our portfolio companies, hey, if you have a founder that we should meet, please introduce us. There's two sources of introductions for VCs that they seek or they're open to. Founders in their portfolio and other VCs. When you hear an investor saying, oh, we don't lead, it's because they primarily wait for another VC to send them deals. In that case, only have an investor introduce you to another investor after they have committed to investing or after they have invested in you. Don't let a VC introduce you or an investor introduce you to another investor if they have not invested, unless if it's an investor that, let's say, only invests in space companies with technology for outer space, and you have a fintech company. So they'll obviously will not invest in you because that's not what the fund does, but you're great. So if you have that outer space deep tech technology investor introduce you to a fintech investor, that's fine, that's great. But ideally, it's other founders. Now, the benefit of participating in Techstars is that you're automatically connected to this massive network of over 3,000 companies that have gone through the program, and even the founders that are in your program, in your class, you're introducing each other to each other's investors. That is the most valuable type of introduction. So what happens if you don't know those founders or you haven't gone into Techstars yet? One, apply, but two, what happens if you are not in Techstars yet? Founders in your field are more likely to take a meeting with you if it's a mentorship type of approach where, hey, Andres, I'm also doing something in the advertising space or the fintech space, or you worked in the music industry and you know everything that you should not do in the music industry. This is what I'm building. Could I get your feedback? And I'm putting around together. This is my data room. This is my slides. I just want to hear from your perspective. What am I doing wrong? What am I not looking at? And that is a mentorship type meeting with a founder. In that meeting, a question that I typically ask is, I'm not looking for an intro, but what are the investors that you think I should be speaking to? Now, by saying I'm not looking for an intro, you're not putting them in an awkward spot of they don't like what you're doing, and now you're asking them for an intro, so they're gonna like, yeah, I'll think about it. Or, oh, let me think of who I know. And saying, I'm not asking for an intro, who are the investors I should be speaking to? By removing that pressure, they're gonna say, oh, you should speak to Joe and Jim. And if they like what you're doing, and I'll provide the introduction. If they don't like what you're doing or they don't feel comfortable making the introduction, well, now you know that that Joe and Jim have an endorsement from this founder that you thought the founder was great. So in your cold email to Joe and your cold email to Jim is, hey, I spoke with this great founder. They speak wonders of you. I saw what you wrote on the information about the future of your industry, and I found the same things. And on top of that, I found this and this other thing. Would love to tell you what we're building. This is what we are doing, and we're opening up around. Doing that approach is going to help you either get the warm intro or map out who you should be talking to and figure out a better cold email. If you don't do if you cannot get to those founders to provide that network, apply to Techstars also. But outside of Techstars, you can still get through with investors that are open to cold emails. And in the list I provided, there's even a list of investors that take cold emails. That you can fill out applications, you can do email, and your cold email should still be very, very, very personalized. You're not going to have a 50% response rate. You're probably going to have a 5% response rate, which is why having the 200 to start micro VCs, very well researched, is going to increase your chances. And here I have another question. Would you include pre-revenue metrics in a forwardable email? And what would be concrete examples? Yes, totally. You can have pre-revenue metrics. Revenue is a lagging indicator. There are leading indicators where you can have the leading indicator to the most relevant key performance indicator, which aha moments. When does the aha moment occur? And typically the aha moment occurs with the user before revenue. But it might be that you don't have an aha moment with users because you don't have the product yet. It's not fully released yet, or you only have 3 customers. It's fine. The thing that you want to talk about are the 2 or 3 things that show that you understand your customer's pain and that you have progress, even if it's early on. It could be we have 10,000 people in the wait list. We've interviewed 200 prospective customers and we found this unique insight. Anything that shows that you have progress. Okay, now, how does calendar density work in this market condition? VCs and analysts tend to control the calendar. Yes, they tend to control the calendar based on their availability. But if you're trying to get calendar density Tuesday, May 9th for Thursday and Friday, May 11th, May 12th, it's going to be very difficult. But you can push it further out. So it would be, hey, VC and analyst, would you be opposed to doing our call June 15th? Because this week we're focused on demo day, and then we have our product launch, or we're signing this big deal with a customer. We're heads down doing this thing. Would you be opposed to doing June 15th? And you tell everybody, would you be opposed to doing June 15th? If it's far out enough, they're probably not gonna be like, yeah, I'm opposed to it. It's either meet me tomorrow or don't meet me ever. I've never seen that happen. I have seen it happen when founders are like, hey, Andres, I landed in Miami. I'm going to be here for 2 days. You want to meet up for coffee? No, because I have work. I have a lot of things to do. That is less likely to happen. So don't try to get calendar density by rushing things to like a meeting tomorrow. Do we have data rooms with templates you can access? That's a great idea. I'm gonna have to create a fake data room template so you can look at it, but I do not because most of these are confidential. But it can be as simple, like I showed you a Notion. It doesn't have to be a fancy Notion. It could be a Google Drive. It's just folders, and it has the financial model, the go-to-market, all of those things in folders. And in the top of the folder, like the root of the folder, have a README file so that people can get to the diligence folder on Google Drive or Box or Dropbox, double click the README file, and the README file is the short summary of the company and the directory or the listing of everything that they can find in that data room. All right. Oh, here's a great question. We have been advised to not send a deck before the meeting. What is your take on this? I generally agree with this advice. However, it's typical for a VC, especially an analyst or principal and associate, to prioritize their calendar and who they should meet. And often they're looking to filter out or make a decision before meeting with you. That is why I have 3 different decks. The first one is the emailable deck. And that should be, imagine like a trailer of a movie. It is enough to get the meeting, but it's not so much information that they can decide to invest or not invest. And then you have the deck for the meeting, which is, as you're speaking, you have the visuals right here, the big numbers, the graphs. And then after you've met, that's where you have the leave behind deck, which is the deck with all the appendixes, the 30 slides with 30 appendixes, and that if you read it, you don't need the founder to be there reading it to you, you can understand it. But that's after the meeting. What app am I using for the thing? I'm using Prezi Video. That's pretty easy. And can you get into Techstars without taking the investment? Yes and no. So every company that accepts the Techstars offer and joins our program will do the common equity transaction, which is a 6% pre-money common, which means that we get diluted pre-money, and common stock is not investor stock. It's not preferred stock. It's not a safe. It's the same type of stock that an employee has, and it doesn't cause a pricing event. And every company does the 6% pre-money common. You get access to the founder network, alumni network, investor network, Texas for life, and like $4 or $5 million worth of perks, including hundreds of thousands of dollars of cloud credits and $20,000 cash to use it however you want. That is for every company. We also offer every company a $100,000 convertible note. Companies that have raised significant funding, I have accepted companies that have raised $1 million, $2.5 million before the start of the program, or like I did, I had raised $1 million like 2 weeks before my start of the program. Those $100,000 is optional for you to take. We offer it to every company, but you're not forced to take it. You can choose not to take it, especially if you raise money or if you're getting other investors that you would add complementary to Techstars, or even at a better terms, higher valuation than Techstars can offer. You can get that, and you don't have to take the $100,000 from Techstars that comes in a convertible note. Another question a question from Toby. If you're getting multiple responses, but staggered, like you said, the calendar density, do you recommend the initial responded investors meeting, so maybe 3 or 4 weeks, and getting them all into 1 week? I thought speed was key too. Speed is key to answer that email, but do push them. Imagine you have sheep, corral them into as tight pen as possible. And so the first email, you'd be pushing them for 3 weeks. And then the last email, the email that is closer to that 3 weeks from today, that you're going to be asking them for a meeting next week. So the first ones are going to wait a little bit longer. The last few ones are going to be tight on their schedule. And so the last ones are going to be the ones that are a little bit harder, because they're going to say, hey, I'd love to meet, but like I can't next week. Fine. Then it's the week after on Monday. But now you've condensed as many meetings as possible. Okay, here we have another question. So basically, the warm intros are simple link passing by a middleman, which can even be unknown, instead of thorough endorsement to refer to a VC, because the middleman knows both the founder and the VC. It is not an unknown middleman. It is the person making the introduction knows the founder and knows the investor. It is the filter that many VCs use to prioritize the meeting, or whether to take the meeting or not. Okay, here's a good one. In my personal experience, Techstars was not very eager to do warm intros themselves. And I have heard this from other portfolio companies as well. Why is this so? I cannot speak for all of Techstars, but I can speak of why my program and myself do this as well. The best introductions for the founders that are able to raise the most money faster are actually coming from other founders in their same class, in their same cohort. Often also from alumni and mentors. The reason why is because imagine that I am a VC that's not Techstars. Techstars invests in hundreds of companies a year. There is the Techstars team or the Techstars employees that are providing hundreds of introductions per year, or thousands of introductions per year. That's going to be high volume. And on the other hand, I have one of the best performing founders in my portfolio, a CEO I really admire, that doesn't do 1,000 deals or hundreds of deals. They just met another great founder at some event or from some other interaction, And this founder is saying, hey, I just met Joe last week, or I had a call with Sam, and what they're doing is really cool. You should definitely talk to them. Because it's a portfolio, it's a company I have already given money to, I am more likely to take that introduction as signal than the group of people who have to do hundreds or thousands of introductions on a yearly basis. So I provide introductions to VCs all the time, but I should be the last resort after your mentor network, which we give you, your alumni or other founders in the class, whether it's past classes or the current class, that provide that introduction. Or if you had an early investor, or like if once you start getting, that 250K at that first tranche, now that they, together with the mentor, together with the founder, are providing the introduction. Now you're getting multiple signals of the VC, where the VC is getting an introduction to you from a founder of the portfolio, an angel investor that invest in, that also invested in you, a co-investor, and Techstars. That's more powerful than having just the Techstars managing director providing the introduction. So we do all of the above, but I prefer to help founders get introductions from other founders that got money from that VC fund. Okay, another question. What if you have the product, customers, and revenue and still cannot raise? It happens, especially in this market. If you have the product, the traction, the revenue, it could be that you're not raising money with a process. But I have also seen companies that have the process, they have the revenue, they have the traction, and they're not able to raise money because of the market size that they're going after. So you might have everything's like great, but your market size is $1 billion total addressable market, $1 billion or 4 billion. And here's where I wanted to connect with the motivations. And I'm going to use this as a segue because this is very important. The motivations behind a VC fund. You see, VC funds have investors themselves. They raise money from investors too. And for a VC to make money, they need to give back the original money that they received. And only after they give back the original money that they received does the investment team or the general partners, the fund managers, get 20% of the profits after they returned all of the capital. So imagine that I have $1 billion fund. Any one company that I invest in, and I invest maybe in 25, 24 companies with $1 billion or $100 million fund, like whatever company I invest in needs to have the chance that when that company exits or IPOs, my ownership is going to be at least equal to the size of my fund. Because most funds are set up for the 1 or 2 out of 10 companies that really hit it out of the park. That's how most funds are designed. So each company I invest in, I believe that at least at the moment that I invest, that they can return, with the ownership that I have, they can return the size of my fund. So let's say that I bought 20% of your company throughout multiple rounds of funding, and I have $1 billion fund. When the company IPOs or there's an exit, my 20% ownership needs to be equal to $1 billion. Only at that point will I start seeing money. So it might be that because of the economics of my fund, because of things that are not related to you, I need to invest in companies that have the low probability, but have a possibility of being a multi-billion-dollar company, which requires it to be part of a massive multi-billion-dollar market or a market that will get there, even if it's low probability. And so I found great companies that are printing money, but they're never going to get to the point of generating billions of dollars of revenue a year. Or at least they haven't been able to communicate that, and they haven't been able to communicate that big vision. And that is one of the scenarios where you can have everything right and still not be able to raise money. But most of the time, when you have the vision, you have the product, you have the traction, and you're not able to raise money, is because founders were unprepared, had no process, and were fundraising part-time. So, to close, here's the advice in 3 parts. Temporarily quit your startup, only a CEO, to focus on closing the round. 80% of the work happens before the first meeting. Your first goal is to overkill in preparation. And your final goal is to generate scarcity and momentum. And I'd love to keep answering more questions, but I'm running out of time. So I will leave you with my email. It is a@techstars.com. And I encourage you to apply to any of our programs. But the Techstars Miami program has applications open until June 7th. Thank you.
Thanks, Andreas. And sorry, I cut your email off there for a little bit, but we'll also put it in the chat for everyone to see. And hopefully everyone here got some good nuggets as they're thinking about reaching out to Andreas's team, hopefully. But thanks again for joining us. And you can access this recording using the same web link that you had to register for the event. But if you have any additional questions, reach out to startups@techstars.com. And we'll help you through your application process. But thanks again, everyone. We hope to see you at the next event.